So for leverage buyout, one is exit value. Well, actually, one is build unlevered free cash flow. Or maybe project is better. Project unlevered free cash flow, UFCF. We'll talk about how to do that. That's the very first thing I do. Why? Because this will give you your EBITDA. This will also give you your cash. Right? Next, calculate exit. Exit. Right? Which is multiple times EBITDA. Most likely multiple times EBITDA. That's before Harry makes terrible. Right? Exit value. What's wrong with the exit value? We need to, this is an enterprise value. Why is it enterprise value? Because it's a multiple times EBITDA. Multiple times EBITDA gives you enterprise value, not an equity value. You'll learn that tomorrow. How do we convert this to an equity value? We need to subtract out the final debt at 2015. How do we figure out what that debt is? Final debt? Equals A. We need to figure out all the cash flows. So sum unlevered free cash flow, add them all up. It's the cash we can use to pay down the debt. Right? B. Calculate interest. How do you calculate interest? It's the debt raised in the beginning times interest rate times years times 1 minus tax. Interest tax deductible. It's a quick way to get the interest. So that says calculate interest, debt raised times interest rate times years times 1 minus tax rate. It tells you how much interest would have been incurred over the 5 years. Then cash pays interest and debt. Then you have final debt. Right? Gives you your leftover debt. Take 2 minus 3, and that's your exit value. Right? 2 minus 3. Yes?
Sorry, I just can't read that last part. It's
cash pays interest and debt.
no, above that, the last part of the parentheses.
Debt raised times interest rate
Yep.
times years times 1 minus tax.
Okay.
Sorry.
Thank you. No, that's fine.
Also, when you sum up the unlevered free cash flows, is that you have to discount that, right?
No, no discounting. Discounting is for present value.
Okay.
This you don't discount because you're assuming that you're going to own and operate the company over those 5 years. So you're actually going to get those cash flows.
Oh, okay.
Yeah? Let's do an example. Can we do an example? Let's say we let's say we want to buy a company. All of us together. The chip in. And we want to know before we do that how much of a return we'll get over 5 years. And that's the point of the leverage buyout analysis. We're going to buy the company, we're going to put some debt on it. What do you need to know from me? 5 years. depend on the entry value.
Where's cash? Cash flow.
We'll have to project it. Good question. What's that?
Where's cash generated?
Yeah, oh, same time. Yeah, we'll have to project that.
How much are you buying the company for?
Purchase price. How much are you buying it
Don't you get that from cash flow? Stores.
You could ask for the cash flow statement. Be smart. Okay, purchase price. Can I erase this? Can I erase this? Sorry. Okay. Let's say I'm going to pay a multiple of 5 times for the business. Yeah? So what else do you need? Let's say the EBITDA is $1 million. Company has $1 million in EBITDA. Okay, so okay. Real simple. We're gonna buy it for $5 million. Now what do you need from me?
How much debt, how much equity?
How much debt and how much equity? Sources and uses, right? So uses. Purchase price, $5 million. Good LBO is a business that doesn't have debt. Let's keep it simple. Let's say there's no debt. There's maybe some transaction fees of about $100,000. Okay. And then sources. How do we determine sources?
How much capital we raised?
Yep.
What leverage we can obtain?
Yep. There's a lot of subjective ways to think about it. Let's keep it simple just so you can understand the thought process, and let's just say that we're going to raise 75% in debt and 25% in equity. Or no, is that right? And to determine that, grade 2 5. Let's, really you'd want to get term A and combination mezzanine, but let's just so you understand the flow. What else? What else? Created that one. No.
Don't you have to cover the 100,000?
Should be in there, no?
Yeah.
Is it?
No, that's 5.
Did I do that wrong?
We have to cover the 100,000 transaction fees. So, accrued about 100.
Oh, you mean in the uses?
Yeah.
I'm mistaken. Now what? Now what do we do? So we have our inputs.
What are the interest rates?
Yeah, interest rates, let's say is 10% interest, just to keep it simple. What would we do with that?
Make adjustments.
Hmm?
Do you make adjustments next?
Adjustments to what?
Just like we did in the main model?
You could, but I'd like you to be more specific. What do we want to know now?
The exit value?
Yes, exit value. How do we determine the exit value?
Check the cash flows.
Cap rate.
Cash flows. So project the cash flows. You guys know how to project cash flows? All learned about DCF? Unlevered free cash flow? We'll go through it. So, free cash flow is UFCF, unlevered free cash flow, is the cash flow produced by the business most directly related to its operations and before debtors and equity holders have been paid. And where it comes from is it's a simplification of the cash flow statement. You should never have to memorize what the unlevered free cash flow is if you can think about where it comes from. Where it comes from is it's a reduced portion of the cash flow statement. So let's walk through a cash flow statement. What are the line items for a cash flow statement? Net income? What else? Depreciation? Deferred tax? Working capital? Right? It's cash from operations. Cash from investing? CapEx? Negative? Could have some other, just generalize all those other line items on an income statement, on a cash flow statement to be other purchases, sales, investments. Then you have cash from financing activities, which is what? Short-term debts, long-term debts, stock, dividends, minority interest, are the major line items. You have cash. That's a cash flow statement, more or less. But in an unlevered free cash flow, we want a measure of cash that's without debt, as if debt wasn't there. Why would we want that? Well, in an LBL situation, if there was any debt on the business or any shareholders on the business, they're gonna go away. We're gonna pay down the debt. We're gonna buy out the shareholders. And in discounted cash flow, we look at the same type of cash flow for a different reason. We'll learn tomorrow, because we just want to look at the core operations. Either way, debt's gone, equity's gone. We also want to look at the business based on everyday operations, most directly related to the operations of the business. So if there were any other extraordinary purchases or sales, we'd want to eliminate it. We want to simplify it. The idea of the cash flow being unlevered means before debt, would also mean we'd have to eliminate the effects of interest on this. So at the bottom, we'd have to add something called after-tax interest expense. you'd have to add back after-tax interest. So the definition of unlevered free cash flow is net income plus depreciation, deferred taxes, changes in working capital, less CapEx, plus after-tax interest. So it's a simplification of the cash flow statement. You don't have to memorize the line items. No one ever breaks it down like that. I don't know why. However, you probably see unlevered free cash flow, if you learned it in business school, starting with EBIT, not net income. And there's a couple of reasons why you would start with EBIT. If you think about how to build to unlevered free cash flow with net income, but if the starting point that you have is EBIT, not net income, how would you build to this number? Bless you. You would still add back depreciation. You would still add back deferred tax. You would still make adjustments to your working capital. You would still change CapEx. But this is already before interest, so you don't need to do this. It's already before interest. However, net income after tax, this before tax. So you would have to make an adjustment for taxes. And it's very important to know that the tax adjustment that you make is EBIT times tax rate. EBIT times tax rate. It's not the taxes from the income statement, because the taxes from the income statement has interest in all in there. So you gotta take EBIT times the tax rate. And if you do this in a model or something, you'll get the same exact number. So this is what you've probably learned. And it's just a simplification of the cash flow statement. And if you think about these line items, and if you think about an income statement, let's say you're not using deferred taxes in your business. That's fine. And let's say working capital is manageable. If working capital is manageable, it could be maybe 0 or consistent. EBITDA is a big component of this. And that's why a lot of people say that EBITDA could be a close measure of cash flow. Because you can just take your EBITDA and maybe make an assumption for CapEx and apply a tax rate to it. And it's a very, very quick way to get to cash flow. Very important, because quite often you're given EBITDA or EBIT in an interview and asked to build to cash flow. So that being said, let's build out cash flow for this business. Okay, so let's say we know that the company had Can I erase this?
No, don't erase it.
Okay. Let's say the company had in 2010, let's do 2011. You know what, I'm going to start writing after EBIT, D&A. Let's just do working capital, CapEx, tax, let's say is 35%. And let's say say in 2011, 2011, 2012, 2013, 2014, 2015. Steve, I know you got that second race.
Yeah.
Let's say the EBIT is 950, D&A is 50. Let's say working capital is 100. No, let's say working capital is 25. CapEx is another 50. It's minus, minus, plus. And taxes is 35% of that, whatever that is. Yeah? And let's say, you got it?
Yeah.
Let's say that we'll grow out EBIT at 10% per year, and all these will stay flat. Just to be simple. Can anybody do that quickly? Think so? Try it on the side.
Bless you.
Nice. So I got 36449 as the sum of all of them. It's the sum of all the cash flows. Good. I might have made a mistake. And I got 13909. 1390900 as the 2015 EBIT. And sorry, 15 EBITDA. Yeah? Everyone have that? Sorry. No? Okay, not everyone has to do it. I mean, yes.
And the value, you use 5 years, always.
Sorry?
You use always 5 years,
No. Sometimes
Okay.
7. Depends on the situation.
more than 5.
Sometimes. It really depends on,
But
huh?
in the current situation, that you cannot, for example, you cannot forecast like 5 years, you know, it's like,
More
it's too much
common.
risk.
More commonly, it would depend on the length of the fund. If your investors are expecting a return in 5 years, if it's a 5-year fund or a 7-year fund, it's usually what determines it. Okay, so the idea is that the lesson isn't to build discounted cash flow. That's tomorrow, but the lesson is that you know what to do with these numbers. Anyone have questions on how to do this? We have enough modeling to do later. Okay, so now what? Now what do I do? Anybody? What next? How do I determine my value, my return? So I have the purchase price. I know the uses, I know what I have to pay for. I know how much equity I put in, my investment. I know how much debt.
How much you sell it for.
Yeah. How much I sell it for. How do I determine how much I'm gonna sell it for?
5 times the 2015.
Yeah,
EBITDA.
5 times this EBITDA. Why 5? We are conservatively assuming if I paid 5 times for it, I will sell it for 5 times the exit EBITDA. And so that's about 7204.5. So this times 5.0 equals 7204.5. Alright, this is my exit value. Exit. Exit enterprise value. What's wrong with this exit enterprise value?
You haven't accounted for debt.
I haven't accounted for debt. So what I need to do now is I need to figure out what my final debt is. How do I figure out final debt? Anybody? How do I know how much debt I will have in 2015? What do I need to do? Oops.
Debt remaining after the interest expenses?
Sorry?
The debt remaining after the interest expenses?
After interest. So we'll need to calculate the interest. How do we calculate the interest?
EBIT minus the rate. Equation.
3825000 from here. The original debt times interest rate times 5 years times 1 minus tax. That's the interest incurred. $669,375. Right?
And you're assuming a 35% tax rate.
Yeah. I assume 35% tax. Maybe something different?
Is that 66 or?
669,375. What do I do with that?
Cash flow and then subtract exercise.
Yes, either subtract cash or add it to the debt. It's the same thing. Yeah. So cash pays that, and it pays down any leftover debt. Or Brittany said is you can just add this to the debt balance and then see how much you can pay down. There's a couple ways to do it. So let's just say cash pays this down. So what's 3644.9 minus 669,374? $2,975,525. So cash. So I'd say for just A, cash pays interest, which is 3,644,900 minus 669,375 equals 2,975,525. Yeah? just cash pays the interest. And this leftover cash pays down as much debt as we can. Everyone okay up to here? Yeah? So we added up the cash. This is the final debt, calculated the interest, cash pays the interest. That's it. This is what's left over. What do we do with what's left over? Pay down the debt. See how much debt we have left over. So 3825 minus that. Yeah, 3825000 minus 2975525. Yeah? Did I do that right? Did I do something wrong? That's the debt. That's the final debt. 849475. So again, what we did was we made cash flow projections. Took the final EBITDA. Calculated a multiple to get our exit value. What we're missing is the final debt. How do we calculate final debt? We take the beginning debt and calculate the interest. Cash pays that interest, gives us all this cash left over, and this is used to pay down the debt. 849475. Yeah? Questions? So the return to us is enterprise value minus the debt.
That's not much. I keep getting a different number when you calculate the final debt. Like that 3.825 million times 10% times 5 years times 1 minus the tax rate.
What tax rate are you using?
Well, I'm using 1 minus 0.35.
Okay. Is anyone else getting a different number? I could have done something wrong. 3825000. What did I do? I mean, what? Sorry, I did too quick. 1243125.
Yeah, that's the number.
Sorry. Sorry, guys. 1243125 is the interest. I'm doing this too fast. 1243125. So cash pays that interest. Yeah. Got to change that cash left over. So the cash left over. 2401775. Slow change. 1423225. Is that what you're getting? Yep.
Yeah.
So what do we do with that? What's the debt left over? Anybody? It's the final debt. What do we do with the final debt? Yes. I think yeah.
Subtract it from the
Right. So the enterprise value, 7204, keep the same units, minus the 1423225 gives us the money that we get. Right? $5781.3. That's our return. Make sense? Questions on that? How do we calculate the IRR? The IRR formula so what's the money we invested? How much do we invest in this?
5 million.
Huh?
5 million.
No?
51.
1275.
1275. So much equity we invested, right? The 1/5, 5 years, minus 1, right? I think that's 35%. It's the IRR.